What if someone drew a red line around your neighborhood and quietly changed your family's future? No wall appeared. No sign said, "Keep out." The streets looked exactly the same, but to banks and government officials, that colored line could make the neighborhood look dangerous. Not dangerous because of floods or fires, but because of the people who lived there. This is the story of redlining and how ordinary-looking paperwork helped divide American cities. Redlining means denying or limiting credit because of location, even when an individual might qualify. The name came from neighborhoods marked red and judged the riskiest places for mortgage investment. But the complete story is more complicated than one map, one agency, or one decision. Housing discrimination existed long before federal officials began coloring neighborhoods green, blue, yellow, and red. American cities already used segregation laws, racial covenants, violence, and discriminatory real estate practices. In 1917, the Supreme Court struck down a Louisville ordinance requiring black and white residents to separate. Yet segregation continued through private agreements, intimidation, zoning choices, and decisions about who received credit. Then the Great Depression arrived. Banks failed, unemployment soared, and homeowners struggled to pay mortgages. Mortgages were different then, often short, expensive, and ending with one enormous balloon payment. If families could not refinance that final payment, they risked losing everything they had invested. In 1933, the federal government created the Homeowners Loan Corporation, usually called HOLC. HOLC purchased troubled mortgages and replaced them with longer loans carrying more manageable payments. Between 1933 and 1936, it refinanced over 1 million mortgages across the United States. That was roughly 1/5 of the nation's owner-occupied homes, a major rescue during an emergency. But officials also wanted detailed information about cities and the mortgages the government now held. Beginning in 1935, HOLC's City Survey studied residential neighborhoods in hundreds of American cities. Field agents consulted local lenders, real estate professionals, appraisers, and federal housing officials. Together, they divided cities into areas and assigned each one a mortgage security grade. Grade A was green and called best. Grade B was blue and still desirable. Grade C was yellow and considered declining. Grade D was red and labeled hazardous. Surveyors examined building age, property values, transportation, industry, and the condition of local housing. Those factors could affect lending risk. But evaluators also recorded residents' race, nationality, and social class. Their reports used openly racist and xenophobic language to describe many Black and immigrant communities. Even small numbers of Black residents could be treated as evidence that an area's value was threatened. Stable Black neighborhoods could therefore receive low grades despite homeowners, churches, businesses, and community institutions. In the survey's early weeks, some Southern Black neighborhoods were even placed in a separate 5th category. Officials soon folded those areas into Grade D, the red category considered most hazardous for lending. These maps were not handed to every neighborhood bank or displayed publicly like modern zoning maps. Their circulation was limited, mostly within government, and historians debate exactly how lenders use them. So it is too simple to claim that HOLC's colored maps single-handedly created redlining everywhere. The maps documented existing discrimination, but also organized and legitimized its assumptions through federal authority. Another federal agency had an even more direct role in reshaping the American mortgage market. The Federal Housing Administration, created in 1934, insured mortgages that followed its lending standards. Federal insurance reduced lenders' risk and helped make long-term, lower-payment mortgages widely available. This helped transform homeownership. But the FHA's standards treated racial integration as a financial danger. Its policies favored new, racially homogeneous developments and supported barriers that kept neighborhoods segregated. Private banks, realtors, developers, insurers, and government agencies formed an overlapping system of exclusion. A Black applicant might have steady work and savings, yet still be denied a conventional mortgage. Realtors might steer that family away from white neighborhoods or refuse to show available homes. Developers could attach racial covenants to deeds, promising that homes would not be sold to Black buyers. And intimidation or violence could enforce boundaries whenever contracts and lending rules were not enough. Meanwhile, many white families gained access to new suburban homes with federally supported financing. Those homes were not free. Families worked, made payments, repaired them, and carried financial risk. But access to an affordable mortgage created an opportunity that many Black families were systematically denied. A home could rise in value while each payment allowed the owner to build equity. That equity could fund education, cover an emergency, support retirement, or help start a business. Parents could eventually pass property or financial help to children, creating an intergenerational advantage. Families excluded from ordinary mortgages sometimes rented longer or accepted exploitative contracts with few protections. Missing one payment under some contracts could mean eviction and losing everything previously paid. The inequality therefore extended beyond where families slept. It affected who could accumulate and transfer wealth. Neighborhoods considered risky also struggled to attract normal credit for repairs, construction, and local businesses. With investment restricted, buildings could deteriorate and opportunities could leave for better funded areas. Officials could then point to that deterioration as proof that their original low rating had been correct. It was a self-reinforcing cycle. Low ratings discouraged investment, and disinvestment produced visible decline. Other public decisions added new damage. Highways and urban renewal projects often cut through Black neighborhoods. Families lost homes, businesses, customers, social networks, and institutions that had taken decades to build. In 1948, the Supreme Court ruled that courts could not enforce racially restrictive housing covenants. Yet discrimination persisted through lending, steering, intimidation, local policy, and countless private decisions. In 1968, Congress passed the Fair Housing Act after years of civil rights organizing and political struggle. The law prohibited race discrimination in housing sales, rentals, and financing, including mortgage lending. Passing that law mattered enormously. But a new rule could not instantly rebuild neglected neighborhoods, nor could it immediately replace decades of home equity that excluded families never had the chance to build. Researchers today connect formerly redlined areas with continuing differences in wealth, health, heat, and pollution. Redlining is not the only cause. Jobs, zoning, highways, schools, and many other policies also mattered. But the old maps reveal how racism can operate through ratings, forms, boundaries, and routine decisions. A system does not need one villain secretly controlling everything. It needs rules that repeatedly produce unequal outcomes. Look up your city's historical security map. Compare its colored boundaries with the city you recognize today. The red ink may have faded, but highways, property patterns, and neighborhood boundaries can preserve its history.
That's real Stickman history. Badly drawn people, real documents, and consequences that outlived the ink.